The crisis in Egypt has also brought attention to the Suez Canal, the 141-year-old waterway. It's a key shipping link between Europe, the Mediterranean, as well as Africa and Asia. About 5% of the world's seaborne crude oil passes through the Suez Canal. But could the future of the canal affect your portfolio? Well, my guest, Natasha Boyden, is an expert. She covers the shipping industry for Cantor Fitzgerald. Natasha, great to have you with us. Always a pleasure. So what is the significance for investors when it comes to the Suez Canal? We know that a lot of oil transits the canal.
Right.
Is this going to mean longer trips? What has happened? Bring us up to date.
Okay, basically what's happening is the canal right now is under military control. So there's no real danger of it being closed, which is a good thing, depending on your point of view geopolitically. In terms of what it would have an impact on if it were closed, what would happen is all those ships that are transiting the canal would have to go around the Cape of Good Hope, which adds about another 6,000 miles to the journey, which is about another 20-odd days to a journey going west. So
are many of the shipping companies concerned about this?
You know, there's certainly, I think psychologically the concern is there. As I said, we've not seen any real closures coming into play yet, but psychologically I think you've got shipping companies lined up ready to make that transition to the longer journey if they have to.
What have happened to rates when you look at the different categories of ships right now?
Nothing. Nothing has happened. I mean, they spiked a really small amount on Friday on the Suezmaxes, but other than that, they really are still in the doldrums. Rates right now are pretty unacceptable. They're below break-even on many routes.
I noticed in one of your recent notes you talked about Cape-size vessels, and the rates on Cape-size are so low that some operators have had to pull ships out of service.
Yes. They're basically just putting them into sort of dry storage because they're below break-even. They can't make any money off it. Unfortunately, what's happening in the industry as a whole is there's just too much supply coming on. You've got a 28% order book for the oil tankers. You've got an almost 50% order book for the dry bulk carriers. And demand just isn't enough there to stop up that supply coming on.
So it's just a question of supply and demand.
Correct.
Those order books really did come through. We looked at the financial crisis and thought that maybe that would curtail some of the completion of the ships. But
and it did to some extent. I mean, we did see slippage. Last year we saw about 40% slippage of the order book, but that was just pushed back. So the problem is still going to be here, whether it's in 2010 or it's in 2011, the problem will still remain.
Sounds almost like the housing crisis. The supply remains.
Right, exactly.
So can we look at the disposition between the dry bulk sector and the tanker industry right now? Which is healthier?
Oof,
or is that sort of a race to the bottom?
But yes, basically. I mean, neither of them. I mean, we're not particularly keen on either of them. I would say if we had to invest in one over the other, we would probably go with dry bulk, even though the rates are very, very low right now. But there are some operators out there who have healthy balance sheets, who have long-term contracts. You know, in terms of the tankers, a lot of the operators now are spot-focused, so they don't have any long-term charters to cover their revenue out, you know, for this year and next year. So they're going to have to bear the brunt of the rate crisis now, which is certainly, you know, it remains to be seen how many quarters they can go losing, you know, a lot of money without being affected, you know, intrinsically.
So what are the best companies right now? What are the ones that have the best balance sheets that can deal with this low rate environment and perhaps even make an acquisition or two at a very low cost?
Sure, and that's a good point that you make. The asset values have come down dramatically from the peak of where they were. They're down in tankers, they're down about 40%. And dry bulk,
tankers on sale, so to speak.
Yeah, it's a fire sale on tankers. So yes, you're right. There are some companies out there that do have firepower to buy tankers in this market. One of them would be double hull tankers. They have about 9 ships. They're fairly small, and they have contracts going out to 2012.
So they're a little bit insulated from the spot market.
Yes, absolutely. And they just bought a new VLCC for $55 million, which was just in line, but well below, you know, the highs that we saw last year. And we think they have firepower for a couple more vessels that they could buy, and they have a 9% yield.
9% yield?
Actually, 8%.
8% yield on double hull tankers.
On double hull tankers, and very sustainable, we think, given the contracts they have in place. So that's a very safe play that we actually like very much, and we're putting investors into.
What about the financing that's available available, do you think investors or banks, they're going to be willing to support the shipping industry for much longer?
I think the banks are. I mean, I think the banks supported most of these companies through the real crisis of 2008, when the market just collapsed. So I think it's not in the bank's best interest to have a book of ships on their portfolios. So I think they will support the companies.
All right, I want to thank you very much, Natasha Boyden. Always a pleasure coming to us from Cantor Fitzgerald, your insights on the shipping industry.